I want you to think carefully about the kind of market you are looking at right now, because a lot of people are looking at the same tape and drawing the wrong conclusion. The S&P 500 and the NASDAQ have staged what looks very much like a full V-shaped recovery in a very short period of time. Bitcoin too has moved sharply, going from roughly the mid $60,000 range toward $80,000 in about a month. Most people look at that and conclude the danger has passed. I do not think that is what the market is telling you. What I think the market is telling you is something far simpler and far more dangerous. Investors saw the extension of the U.S.-Iran ceasefire. They saw that the conflict had not yet exploded into the worst case global shock, and they decided to buy first and ask questions later. At the same time, corporate earnings have remained strong enough to keep large-cap U.S. stocks supported, and the momentum in artificial intelligence has not slowed down at all. Every time a new model appears, every time another giant company raises spending, every time another research update hits the tape, money rushes right back into the same themes, that is, the environment. But I would not confuse relief with resolution. Oil is still high because supply risk around the Strait of Hormuz has not gone away. The ceasefire is still fragile. Iran has not been fully resolved. We are still seeing reports of tension, more attacks, more posturing, more reasons for the energy market to stay nervous. So what you have right now is not a clean, all-clear signal. You have a short-term relief rally resting on the belief that the worst did not happen immediately, combined with strong earnings and continuing AI enthusiasm. That is very different from saying everything is fixed. I will go further than that. I think this setup still looks irrational. I think we could very easily see a larger dip again, but I also think a lot of people are getting the next move wrong because they are treating uncertainty as a reason to do nothing. That is almost always a bad habit in markets. When I look at what is happening, I see something very familiar. Human beings are greedy before they are rational. They want to make money first. They explain the risk later. The market is moving up right now because a lot of capital has chosen to assume that the conflict will stay contained, inflation will not spiral, oil will settle down, earnings will keep coming in, and AI will continue to justify higher multiples. That may turn out to be right. It may also turn out to be badly premature. But even if that assumption is premature, the market can still go higher over a longer horizon. That is one of the hardest lessons for people to learn. The macro picture can still be messy, war can still be unresolved, inflation can still be uncomfortable, and yet the higher time frame can still point up because the market is always trying to price tomorrow, not today. That is why I keep coming back to the same practical conclusion. Waiting on the sidelines for the perfect crash can be more expensive than being a little early. I saw data recently that captured this mentality very well. A large global investor survey showed that a majority of retail investors expect stock markets to be higher in 12 months, a meaningful share plan to invest at least $10,000 over that period. More than half believe Bitcoin will also be higher a year from now. A surprising number are planning full portfolio overhauls while also holding more cash in reserve. In other words, people want upside, but they also want protection. That instinct is sensible. The mistake is when protection becomes paralysis. People say the ideal scenario would be a 20% correction that gives everyone the perfect chance to buy. Of course it would. Everyone likes bargains in theory, but bargains do not arrive on demand. And I have been around markets long enough to know that the investor who sits in cash waiting for the perfect setup often winds up buying much higher or not buying at all. So let me save you some time. For most people, the sensible move is not to make some heroic bet, and it is not to sit frozen waiting for a collapse that may or may not come. It is to systematically dollar cost average into the most asymmetric opportunities you can identify, while also keeping some real firepower in reserve in case the larger dip does show up. That is not an exciting answer. It is a profitable one, historically. Markets spend much more time in bull conditions than bear conditions. The S&P 500 has finished positive in the majority of years. If your life is still in the wealth accumulation phase, being absent from the market while one of the largest technological build-outs in modern history is happening is not caution. It is self-sabotage. And I am not just talking about another software cycle or another consumer fad. I am talking about a possible restructuring of the economy itself. Look at what the most powerful entrepreneurs in the world are saying out loud. Elon Musk has openly talked about government checks as a response to AI-driven unemployment. Sam Altman has spent years pushing some version of universal basic wealth. Policymakers abroad are already discussing versions of the same idea. You may think that future is 5 years away, or 15 or 50. That part matters less than people think. The important thing is that the people closest to the machines believe the machines are going to change work in a profound way. When the people building the future all agree on that much, I pay attention from where I sit. There are two broad paths in front of ordinary people. One path is to do nothing, stay a consumer inside somebody else's system, live off whatever scraps and allowances the next economic model hands out, and rent your life from the people who own the productive assets early. The other path is to prepare now, build ownership now, and put capital behind the assets. Companies and networks most likely to sit on the winning side of the shift. That does not mean money solves everything. It does not. Money does not create meaning. It does not replace character. It does not rescue a life without purpose. But it does decide which school district your children live in, which neighborhood you can move to, how much stress sits in your house, how much freedom you have when trouble shows up, and whether a major problem remains a problem or becomes a catastrophe. I have never believed money is the ultimate scorecard in life. I have always believed financial weakness narrows your choices, and right now we are already seeing the wealth transfer begin. Anthropic has reached another enormous valuation. Apple has been moving through a major transition. Google, Microsoft, and Meta have committed astonishing sums of capital to AI infrastructure. Hundreds of billions are being spent, not on stories, but on capacity, power chips, data centers, and systems. That is not theory. That is not a distant dream. That is money already moving. The public is still half asleep. I remember very clearly what disbelief looked like when earlier global shocks began. At first, people dismissed the warnings. Then all at once the world changed and they were scrambling for basic necessities and trying to explain why they were caught flat-footed. I see a similar psychological pattern. Now, some people insist AI is a bubble. Others insist it will never touch their work. And some of the people who do believe it is real still do absolutely nothing. They watch, they scroll, they complain, they gamble away time and attention, while the people preparing quietly accumulate. There will be winners in this transition and there will be losers. If that sounds harsh, so be it. Markets are not moral systems. They reward positioning, patience, preparation, and nerve. Now, before anybody gets lost in the noise, I want to simplify the real needle movers. There are 5 things I would pay the closest attention to from here. The first is Iran, not headlines in isolation, but whether the conflict actually changes the underlying path. The most important question is whether the situation spills into something broader, especially something that disrupts shipping or forces a much larger direct military response. My own view is that a full ground invasion remains unlikely, but the messy middle is still very much alive. That means flare-ups, shipping threats, more testing, more negotiation, and more uncertainty. The second is oil. Oil is the fastest transmission mechanism from war into everything else. If oil stays high, inflation pressure stays alive. If oil cools meaningfully, markets get breathing room. If you want one variable that can quickly alter the tone across equities, housing rates, and risk assets, watch oil. The third is inflation and rates. Jerome Powell is on his way out, and Kevin Warsh is expected to take over. That matters. Markets care deeply about whether the next regime is more willing to cut, more willing to tolerate inflation, or more focused on debt management. Even before actual cuts arrive, the probability of future cuts can move markets. That is why rates matter even when nothing has formally changed yet. The fourth is earnings. This rally has had more support than people admit because companies have still been producing strong numbers. As long as earnings stay solid, the market has a real floor under it. If that weakens, the story changes. The fifth is AI optimism. The market is still trading on whether investors believe the AI build-out remains intact. That belief was shaken when low-cost competition headlines caused a violent sell-off before. It can be shaken again, but so far every genuine AI update has brought the bid right back. Put all five together and the picture gets clearer. The Iran situation looks better than it did at the point of maximum fear, but not cleanly resolved. Earnings remain strong. AI still supports the tape, but oil is still high and the Fed is not meaningfully easy. If oil eventually cools, inflation stays contained, and companies keep printing solid numbers, I think the market grinds higher. If oil remains elevated and inflation reaccelerates while policy stays tight, another meaningful correction becomes easy to imagine. That is why I am not in the business of certainty here. I do not need to be right about the exact path. I just need to be positioned so that the long-term direction works for me and short-term volatility does not take me out. And on that front, my view is simple. Over 2 years, 5 years, and 10 years, I still believe markets go higher. I do not say that because I think every month will be pleasant. I say it because too much capital, too much technology, too much productivity, and too much institutional incentive are aligned behind higher asset prices over time. If you agree with that broad thesis, then you should already have positions. You do not need to know the exact bottom. You need to be in the arena. Now let me tell you where I see asymmetric upside, because that is where the real question always goes. It is not enough to say, own something. You have to ask what kind of thing for me. The best setups usually come from a confluence. I want a strong narrative before the crowd fully understands it. I want a place where attention and liquidity are likely to flow. I want upside that the market has not fully priced. And I want something that either held up better than expected during stress or sits at a level where the downside is clearly definable. That framework has served me well before. I have seen it with early ecosystem trades when the market thought crypto was dead. I have seen it with assets that looked absurdly cheap relative to the narrative building around them. I have seen it in moments where the first purchase went against me and the second purchase wound up making the entire campaign. The point is not the anecdote. The point is the structure. Right now, I am building watch lists around assets and sectors that held up better than they should have during uncertainty. Narratives that are still developing under the surface. And names where liquidity will likely return the fastest when markets regain confidence. That is especially important in crypto because money does not return evenly. It rotates. One pocket moves, then another, then another. If you are paying attention, you can see the sequence. If you are asleep, all you notice is that everyone else suddenly became rich at once. The first pillar for me remains Bitcoin. My thesis there has not changed. Above the low $70,000 range, the larger thesis still looks intact. If Bitcoin trades in the $60,000 to $70,000 zone, I view that as attractive accumulation territory. If the market ever hands out another move toward $50,000, that becomes the kind of day where I would be far more aggressive, not because fear feels good, but because predefined levels matter. When an asset you believe in revisits a major zone, you should not have to rediscover your conviction in real time. At the same time, I keep Bitcoin as part of a broader portfolio, not my whole identity. Sometimes Bitcoin outperforms everything. Sometimes the better trade is elsewhere. The key is knowing what role it plays for you. The second pillar for me is hype. What attracts me there is not just the chart. It is the structure. The fee generation is real. The earnings power is real. The liquidity is deep. The platform has become much more than a crypto-only venue. It is moving toward a broader financial layer where commodities, indices, and traditional market exposure can sit alongside crypto activity. The deeper point is that it is not just a token with a story. It is a system already showing cash flow characteristics, buyback mechanics, and user behavior that can justify much larger attention if the cycle turns risk. And again, that does not make it risk-free. Nothing in that arena is risk-free. There are real questions about validator decentralization and about how the market will value these structures if sentiment weakens. But in terms of conviction, it is one of the alt exposures I take most seriously. If you want a more leveraged way to express the same theme, then PER becomes interesting to me because it acts as a treasury style wrapper around that ecosystem. The reason these kinds of vehicles matter is that when traditional capital begins chasing crypto beta through regulated channels, Treasury vehicles can move harder than the underlying asset. They are not always cheap. They are not always timely. But when the conditions line up, they can become powerful amplifiers. MicroStrategy is another example of that principle, this time around Bitcoin. If you are bullish on Bitcoin and you understand how leveraged public equity wrappers behave when that underlying asset moves, then you understand why these names remain relevant. I am not blind to the risks, but I also know what happens when institutions want exposure quickly and choose the wrapper instead of the raw asset. Then there is the meme coin allocation. I treat that part very differently. That is not core capital. That is not where I build my foundation. But every cycle tends to produce one or two large high beta names that capture an absurd amount of attention once the market really turns hot. Right now, Pengu is one of the names I keep on the watch list for exactly that reason. Not because I think it is the most noble asset in the world, because I know how capital behaves when retail wakes up and wants a symbol, a brand, and a liquid target. I also keep an eye on BMR as a way to express the Ethereum side of the trade if and when that narrative regains force. Ethereum is not dead. Solana is not dead. The market will decide which networks capture the next wave of attention, but I want exposure to the structures that could move hardest if that rotation arrives. When I put all of this together, my portfolio logic is not complicated. I want a core in Bitcoin. I want selective alt exposure where I believe the structural case is strongest. I want leverage wrappers where the reward justifies the extra risk. I want some dry powder in reserve. And I want to stay flexible enough to add if the market gives me another fear event. That is it. No magic trick, no secret password, no need to predict the next headline before it hits. The real work is filtering noise, building conviction, and staying anchored while everyone else gets whipped around by the tape. Conviction matters because without it, you will sell the right thing at the wrong time and buy the wrong thing for the wrong reason. I have learned that clarity is valuable, but calm is even more valuable. In stressful seasons, you need something that keeps you from becoming a servant to every move on the screen in my own life. Grounding matters. A man who is not anchored becomes reactive, and a reactive investor is usually an exit opportunity for someone else. So here is the practical takeaway. Pay attention. Do your own work. Do not confuse a relief rally with a solved macro picture. Do not confuse uncertainty with a reason to be absent. Keep your long-term thesis clear. Keep capital working, keep some reserves, build your watch list before the crowd comes back, and when the opportunities that fit your framework show up, act like somebody who prepared for them instead of somebody who needed the crowd to tell him what was already obvious. That is how you stop being a spectator in somebody else's wealth cycle. That is how you give yourself a real shot at owning part of what comes next.